All right, let's unlock some serious financial knowledge today. We're diving deep into options. Trust me, this is way more exciting than it sounds.
Oh, absolutely.
We're going to decode the world of options. You ready?
I'm ready.
Okay, so before we get into the really complex stuff, let's just make sure we're all on the same page. An option gives you the right, but not the obligation, to buy or sell something at a specific price by a certain date. What makes options so different than just buying or selling stock?
Well, you have flexibility. So with an option, you're not locked into making a decision. You have the power to choose whether or not to buy or sell. And that all depends on how the market is moving. So it's almost like having a safety net or a chance to really win big, depending on the type of option that you choose.
So it's all about choices. Now, my notes mention these things called call and put options. They sound kind of aggressive. What's the deal with those?
Yeah, the names can sound a little intimidating, I know, but they're actually pretty straightforward. A call option means you're betting the price of something will go up, like a stock price. Think of it like you're optimistic about a company. And then on the other hand, you have a put option. That's a bet that the price will go down. So if you think a company's stock is about to take a dip, a put option might be a good idea.
Ah, okay. So calls are for optimists, and puts are for, well, maybe not pessimists, but people who see things maybe going down a bit.
Yeah.
Makes sense. But there's got to be more to it than just up or down, right?
Oh, yeah, absolutely. We have all kinds of terms to help us understand these options, like strike price. You can think of this like the magic number. That triggers your option.
Okay.
So if the price of the asset hits that strike price or crosses it, your option becomes what's called in the money.
In the money. I like the sound of that.
Yeah.
So it's kind of like a game then, trying to predict if and when the price will hit that strike price.
It's definitely a game of strategy, yeah. And predictions, but with calculated risks. And then you also have what's called an expiration date, which is basically a deadline for using your option, like a use it or lose it situation.
Got it. You got to make your move before the clock runs out. Now, my notes also mention something called American and European options. Does that have anything to do with geography?
It does not. The names are actually a little misleading. American options let you basically exercise them anytime, up to that expiration date, whereas European options can only be exercised on the very last day.
Okay. So they just named and confuse us, it sounds like. Your lecture notes also talk about something called the Chicago Board Options Exchange. Is this like a secret society for options traders?
Not quite a secret society, but definitely a central hub for options trading. And reading those quotes is almost like learning a new language, but essential if you really want to understand the options market.
So instead of just seeing, like, the company's stock symbol and price, we're getting all this information about the options associated with that stock.
Exactly. You'll see things like the bid price, the ask price, the volume, open interest. And all of these will give you clues about how actively traded an option is, what other traders are thinking.
It's like we're getting a glimpse into the mind of the market. My notes also mentioned in the money and out of the money. Professor Riordan used an example with eBay stock.
Oh, yeah.
How do those terms play into this whole game?
So let's imagine you have a call option. And it has a strike price of, let's say, $50 for eBay stock. Now, if eBay is currently trading at $60, your option is in the money because you could buy the stock at $50 and immediately sell it for a profit. Now, on the other hand, if eBay is trading at $40, you're out of the money because it just wouldn't make sense to exercise it at that price.
Okay, that makes sense. So in the money means you're potentially sitting on a profit. Out of the money means you're hoping for a price change in your favor. Makes sense.
Mm-hmm.
But even with out-of-the-money options, they still have some value, right?
Yeah, you're exactly right. And that's where we get into the concept of time value. So even if an option is out of the money, it still has the potential to become profitable before that expiration date. So the longer the time until the expiration, the more chance it has to move in your favor.
So time really is money when it comes to options. It's like a race against the clock to see if that price will move in the direction you need it to. Speaking of money, how do we actually figure out how much an option costs?
Okay, so let's look at an example from your notes. So imagine you're feeling a little cautious about the Dow. So you decide to buy 25 February put contracts on the DJX with a strike price of $246. So to calculate that cost, you would look at the ask price for the option, and that's essentially the price the seller is willing to accept.
Okay, so is it kind of like buying stocks, where you just multiply the number of shares by the price?
It's similar. But with options, each contract represents 100 shares of whatever asset you're looking at.
Okay.
So in this case, you'd multiply 25 contracts by the ask price, which let's say is $3.65, and then multiply that by 100 shares per contract.
let me grab my calculator here. 25 times 3.65 times 100, that's $9,125. Options trading, not for pocket change. So we're buying put options on the Dow here, betting that it might go down. But the strike price is lower than the current price.
Yeah.
So we're out of the money. Does that mean we're losing money already?
Not necessarily. You have time until that February expiration date for the Dow to move below that 246 cycle strike price. And, a lot can happen between now and February.
Okay, so it's a waiting game. Now, we've been talking about stocks, indexes, but Professor Riordan did mention that options aren't limited to those.
Right. You're right. You can find options on all sorts of things, currencies, commodities like gold or oil, even interest rates. It's a massive market.
It's like a whole financial universe out there just waiting to be explored through the lens of options. But with all these choices and all this complexity, why would anyone bother with options in the first place?
Well, there's two main reasons, hedging and speculating.
Yeah.
So hedging is kind of like taking out insurance on your investments. You're trying to reduce those potential losses. If the market moves against you.
So if I'm worried about my stocks losing value, I could buy put options as a kind of safety net.
Exactly. It gives you that right to sell at a certain price, even if the market just completely tanks. And then you have speculating, which is more about trying to predict future price movements and making a profit from that.
Okay, so hedging is about protection. Speculating is about potential profit.
Exactly.
Two sides of the same coin.
Yeah.
Now, my notes mention these things called payoff diagrams. They look a little scary. What are those?
Yeah, they might look intimidating, but they're actually really helpful tools. They show you basically how much you could make or lose at the end of the option's life, depending on, how the price of the underlying asset moves.
So it's like a roadmap for the potential outcomes.
Yeah.
Based on all the different scenarios.
Exactly. And they also highlight something called asymmetry of profit and loss with options.
Asymmetry. That sounds ominous.
It just means your potential gains and losses aren't always equal. In some cases, your potential for profit can be unlimited, but your loss is capped.
So you're saying I could potentially make a ton of money, but my losses are limited. That sounds too good to be true.
It can be a really powerful advantage of options, especially for buyers, because when you buy an option, your maximum loss is limited to the premium that you paid.
So I'm basically controlling my downside risk, but I can still ride that wave if things go up.
Exactly.
Professor Riordan had an example with Dell stock. So let's say I buy a put option on Dell with a $12.50 strike price. How would I figure out my potential profit or loss with that?
Well, it depends on Dell's stock price at that expiration date. So if the price drops below $12.50, you could exercise your option, sell that stock at a higher price, stock in a profit. If the price stays above $12.50, your option would expire and it would be worthless.
So I either win by profiting from the price drop, or I just lose the premium I paid for the option.
Pretty much.
It's like a gamble, but with a limited downside.
Exactly. And this is just one example. There's so many different scenarios, so many different strategies when it comes to options.
My head is spinning. We've covered calls, puts, strike prices, expiration dates, those crazy payoff diagrams. What else is there to know? It feels like we've just scratched the surface.
We've laid a really good foundation. But next, we'll dive into some more interesting ways to combine these options, create different investment strategies. It's kind of like building with Legos. You can use the same basic blocks to create all sorts of different structures.
Okay, I'm ready to build. Bring on those complex combinations and those clever strategies.
Welcome back.
All right, let's get strategic. My notes mention things like straddles, strangles, and even something called a butterfly spread.
Yeah.
These sound more like yoga poses than financial strategies.
I know, right? But they're actually just different ways of combining options to achieve certain goals.
So instead of just buying or selling one option, we're going to get creative and combine them.
Exactly.
Okay, so what kind of structures can we build with these option Legos?
Well, let's start with straddles. A straddle involves buying a call option and a put option on the same stock with the same strike price and expiration date. You're basically betting that the price is going to move significantly in either direction.
So it's a play big or go home kind of strategy.
Yeah, pretty much.
If the stock price stays stable, that's not good.
You got it. Straddles are for volatility.
Ah, okay. So we're trying to capture those big price swings. Now, what about these strangles? Are they similar?
They are similar because they involve buying both a call and a put, but with strangles, you're going to use different strike prices for each. This creates a wider range for that stock to move before you start profiting.
So if I'm not sure about the direction, but I think it'll be a big move. Maybe a strangle is a better choice.
Exactly. But they typically cost a bit more than straddles.
Okay, that makes sense. More flexibility, higher cost. Now, that butterfly spread, it sounds less aggressive.
Yeah. Butterfly spreads are more complex. But the name actually gives you a visual clue. So if you think about the wings of a butterfly, the payoff diagram actually looks like that.
Wait, really?
Yeah.
That diagram looks like a butterfly.
Uh-huh.
Okay, so how does it work?
You buy and sell multiple options at different prices. So you're essentially creating a sweet spot in the middle, where you'll profit if the stock stays within a certain range.
So unlike the straddle or the strangle,
Yeah.
we're betting on the price staying stable.
Exactly. This is for when you think the market might be relatively quiet.
Okay, so we've got strategies for big moves up, big moves down, and now strategies for when the market is just kind of chilling out. What other cool combinations can we do?
Well, there's a whole world of spread strategies, each designed for a specific outlook. But let's move on to something called a covered call.
Covered call. Sounds mysterious. What's the cover part?
Well, a covered call involves selling a call option on a stock that you already own. So you're basically covering your potential losses on the stock by selling someone the right to buy it at a certain price.
Okay, so it's like you can buy my stock if it goes above this price.
Yeah.
But until then, I'm collecting some cash from you.
Exactly.
So this sounds like a way to generate income from my existing stock.
You got it. It's popular with investors who are neutral or slightly bearish on a stock they already own.
Makes sense. So I'm sacrificing some potential gains, but for some steady income and a safety net. Now, what if I'm super bullish on a stock, but I don't want to buy a ton of shares?
You could try a bull call spread. It's designed to profit if the price rises, but with limited risk and cost.
Okay, I like that idea. How do I build this bull call spread?
So you buy a call option with a lower strike price, and then sell a call option with a higher strike price, both with the same expiration date.
So I'm setting the boundaries for my bet.
Precisely. Your profit is limited to the difference in those strike prices, but so is your risk.
Okay, so it's a more controlled way to be bullish without the full cost or risk.
Exactly.
I like it. But what about the opposite? What if I'm bearish on a stock?
Then you do a bear put spread. So you buy a put with a higher strike and sell a put with a lower strike price, both with the same expiration. This profits if the price falls within that range.
So it's like the opposite of bull call spread.
Exactly.
Okay, cool. I'm seeing how these can be custom designed tools, but it is a lot to take in.
It is.
Professor Riordan uses a lot of examples to help explain.
Oh, yeah, he does?
Let's look at the one with Apple. What if I'm bullish on Apple, but not sure how much it will move?
Perfect scenario for a bull call spread. So in that example, he suggests buying a call with a strike price of $170 and selling a call with a strike of $180, both expiring in a month.
So I'm betting Apple will go up, but not too much.
Exactly.
But there's always the risk that it doesn't move like I expect.
Yeah, there's always risk with any investment. That's why it's so important to understand it.
He really emphasizes that. Now, volatility keeps coming up. Why is it so important with options?
It's like the fuel that drives option prices. The more volatile a stock is, the bigger those swings could be, and that makes the options on that stock more valuable.
So if a stock is like a roller coaster, options are like tickets for that roller coaster. The wilder the ride, the more the ticket costs.
Exactly.
But Professor Riordan says you can actually trade volatility itself using options.
Yeah.
How does it even work?
It's a bit more advanced, but instead of betting on the direction, you're betting on how much that stock will move.
Whoa. So not up or down, but how much up or down?
Exactly.
That is next level options trading. How do you measure volatility?
One way is implied volatility, which is basically what the market thinks is going to happen. It's reflected in those option prices.
So by looking at option prices,
Oh.
I can get a sense of how much the market thinks the stock will move.
Exactly.
For example, if implied volatility is really high, does that mean the market is expecting a big move?
It could. It could mean they're anticipating some event, like an earnings announcement or a product launch.
So if I can predict those events, I could profit from trading options on those stocks.
Yeah, but volatility trading is very risky. You're trying to outsmart the market.
That's why he calls options trading the art of managing uncertainty.
It's a great way to put it.
He does mention a few strategies, like long straddles and long strangles. What are those?
Those strategies involve buying both a call and a put option, either at the same strike price, the straddle, or at different strike prices, that's the strangle. They're designed to profit from increased volatility. regardless of whether the stock goes up or down.
So I'm not betting on the direction, just on how big the move is.
Precisely.
So it's like, I don't care which way the roller coaster goes as long as it's a wild ride.
Exactly.
But these are not for everyone.
They're not. Requires a deep understanding of options and a high tolerance for risk.
He compares it to surfing.
He does.
Need to know when to ride the waves and when to head back to shore.
A very good analogy.
Okay, well,
Sure.
I think we've covered a lot, from basic combinations to volatility trading.
We have.
My head is full. But I feel more confident about understanding options now.
I'm glad to hear that. We've explored a lot of strategies. Just remember to find the ones that align with your goals and your risk tolerance.
Right. Options are like tools.
Exactly.
You wouldn't use a hammer to screw in a light bulb,
Right.
and you wouldn't use a straddle if you think the market is going to be calm.
A perfect analogy.
Before we wrap things up, I want to shift gears a little. We've been talking like individual investors, but Professor Riordan mentioned that institutions also use options,
They do.
like hedge funds, investment banks. What are they doing with options?
That's a great question, because it's a whole other world of options trading. Higher stakes, more complex strategies, and the players are some of the most sophisticated in the world.
Okay, I am hooked. I want to see how the pros play this game.
Well, let's take a quick break, and then we'll dive into the institutional side of options trading when we come back.
We're back, ready to explore the world of institutional options trading. It's like we're stepping into the VIP section of the financial markets.
It is. We're going to see how the big players use options to manage risk, enhance returns, and really navigate global finance.
Now, Professor Riordan's notes mention that institutions often use options for more than just speculating on stock prices.
Right, they do. They might use them to hedge against currency fluctuations, protect those massive portfolios, or even make strategic bets on interest rates.
So it's like options are the secret weapon of these financial giants.
In a way, they are. Options give them a level of flexibility and
Yeah.
precision that you just wouldn't get with stocks and bonds alone.
Now, Professor Riordan mentions dynamic hedging. That sounds pretty intense.
It is.
What is that?
It's like constantly adjusting your sails to changing winds. Institutions use it to manage their risk as market conditions change.
So it's not just set it and forget it. They're actively buying and selling options, changing those strike prices and expiration dates to fine-tune their positions.
Exactly. They have entire teams, analysts, traders, constantly monitoring the markets, making adjustments to stay ahead of the game.
That sounds incredibly complex. I'm guessing you need a lot of brain power and computing power to do that.
Oh, absolutely. They're using sophisticated models, powerful computers, analyzing risk, predicting market moves, executing those trades so fast.
Like a high-stakes chess match with algorithms and supercomputers.
That's a great way to put it. It's a world where milliseconds can make the difference.
Now, Professor Riordan also mentions options in mergers and acquisitions.
Yeah.
How do those fit into this?
Well, investment banks often advise companies to use options as part of their strategies. For example, a company might use options to lock in a specific acquisition price while they're still doing due diligence and getting the financing.
So it's like putting a reservation on a company.
In a way, yeah. It gives them time to make sure everything is in order.
What happens if the deal falls through?
Well, they might use options to create what's called a collar around that stock price, limiting their potential losses if they have to walk away.
So options are like an insurance policy.
Exactly. They add flexibility and risk management.
It's amazing how options are used everywhere in finance. We've gone from understanding the basics to seeing how they can be used in complex strategies, even huge corporate transactions.
It's a reminder that the financial world is constantly evolving.
So as we wrap up this deep dive on options, what's the key takeaway for our listeners?
I think the most important lesson is options are a powerful tool. But like any powerful tool, they need to be used responsibly, with a good understanding of the risks.
Absolutely. Whether you're a regular investor or a seasoned pro, options can be a valuable tool.
But you have to approach them carefully, do your research, and never stop learning.
Well said. And on that note, I think it's time to bring this deep dive to a close. I hope everyone has enjoyed exploring the world of options.
It's been a pleasure sharing these insights. The world of finance is full of opportunities for those willing to learn. Keep diving deep, everyone. I leave the hull.